So the point I'm making here is this stock market recovery is actually fairly young, and there's plenty of reason to think that it can last longer, both in terms of duration, but also in terms of magnitude.
Welcome to Long Story Short, a podcast where two financial advisors, one rooted in financial planning, the other in investment strategy, break down the questions we're actually hearing from our clients. Each episode, we tackle one or two real-world issues that matter to high net worth individuals, from market-moving news to personal finance decisions with lasting impact. No jargon, no fluff, just clear, thoughtful insights from the front lines of wealth management. We keep it short, but we don't cut corners. This is Long Story Short.
Hi, welcome to Long Story Short. I've got Adam here. This is Andy. This is our first recording post-Halloween. I'm no longer dressed up as a goofy costume or index fund or anything like that. But I did have the experience of trick-or-treating with my 5-year-old and 3-year-old and 1-year-old. Well, let me tell you, that's not for the faint of heart, Adam. What's did do you get to go out trick or treating? You got young ones too. What was your haul like?
We did a Halloween parade, and I pushed a 2-year-old and a 1-year-old around in a wagon while dressed like a crab. So we did
Crab.
family, Little Mermaid themed. I was Sebastian. My one daughter was
Sebastian,
the Little Mermaid. My other daughter was Flounder. My wife was Ursula. So
your wife is Ursula,
yeah, for any
and
good,
that
yeah, well, like any good
was that
trooper.
her choice?
Yeah, it just rounded out. It rounded out the theme nicely, but in
If I
exchange,
called my wife Ursula, I'm not sure I would have made it out of Halloween
it's
night.
okay. In exchange for my costume shenanigans, I got to reap the rewards of the candy that the little ones can't eat yet. So I'm a Snickers fan, Snickers minis, and then the other stuff is still exciting, but not as exciting as the Snickers. What's at the top of your list?
So Halloween is like it's a holiday I rediscover 100 grand every year. Just a top tier candy. The wrapper makes it look disgusting. It's like that red, and the font is like out of 1920 something. So you never know it's good just by looking at the wrapper, but it's actually amazing.
Well, it makes total sense. It's finance themed, 100 grand.
That's
It's,
right. That's
it's
right.
good. So all things money, we're hitting the end of the year here. I always find that November and December, it's no matter how much planning you do, it's like a big work up to the finish line of the end of the year. After Halloween, it's like you blink and it's the new year. But this is when I get a lot of good questions. It seems like, I don't know, everyone's just thinking about all things planning and feel like they've been procrastinating, but I get a lot of good questions at your end. And life insurance came up last week. So I'm going to volunteer the first topic of talking
Okay.
through life insurance.
I have to admit, I was really bad. I this is like one of those things where you should like walk the walk, practice what you preach. I didn't get life insurance for me until after my third child was born.
That,
That's
that,
bad. It's
yeah,
okay.
that
This is
is
the circle
bad.
of trust here.
That is, yeah, yeah. I don't know if, yeah. Well, you did it. That's all that matters, right? You closed the
Yeah.
loop. And I get asked a lot, how much life insurance should I have? When do I not need it anymore? I'll start by saying a couple of things. And like a lot of planning topics, there's different philosophical angles you can take on how to approach them. And there's not a black and white response to this question. Um, I'll say that from our lens, life insurance is there for a specific purpose, and that is to protect your loved ones in the event of your early death. And usually, this is something that becomes really important when you have dependents or a mortgage or other liabilities or things that you want to make sure are completely taken care of in the event of your passing. When you're young, your need for life insurance is really high because you've got one spouse might have a higher income than the other. You might have kids you want to put through college. You might have a really big mortgage balance. So life insurance early on is really important.
So
And it's
that's I like the way like you phrase that. Like, what's the point of life insurance? It's to protect against your early inability to provide for, say, your family. right? Like again, it's protecting against your life ending, so you can't support your family with these obligations that you have, right? That's like the point to it in its simplest form.
That's why it's there, and it makes it easier to quantify and wrap your arms around how much you might need. And term insurance is usually the easiest way to accomplish that. There's a couple
Right.
different variations of life insurance. Term insurance is just buying pure life insurance coverage for a set term of time. Especially when you're young, it's normally incredibly cheap. And so that's just if you're like, I just want insurance coverage for this window, and
Yeah.
then I want to be done with it, then that's a great, that philosophically, that's kind of where we land for younger families. It's like get whatever term you need, the amount you need to cover that term, and just make sure in the worst case scenario you're protected.
In
Um,
term just describes like you have this life insurance policy for a set number of years. And if you pass away inside the set number of years, you get the payout. If you make it through the 20 years or whatever it is you said, you said at the beginning, then great, you didn't have to use it, right?
yeah,
That's what you mean by term.
right. And then at the end of the term, you don't get any of that money back. That's
Right.
the call that the downside, even though it's cheap and even though it's only for a set period of time. Once the term expires, whatever you've paid in does not get sent back to you. The insurance company
Right.
gets to keep it. But I like it because you can ladder policies. You can get, let's say you've got kids that are 10 and they're going to college in, 8 to 10 years. You can get a 15-year term to cover their tuition. You can get a 20-year term to cover the back part of the mortgage. You could get a 30-year term to stretch closer to retirement. So you can ladder policies at different amounts to control your costs. Um,
Yeah.
but that
I think
pure,
that's a great idea because that's actually not something I think a lot of people don't realize you can do that. Right? Where like you don't have to have one 30-year policy, right? If you want to really protect those early years, you can set up maybe three different policies, one that's 10 years, one that's 20 years, one that's 30 years, just to match up with whatever your relevant dates are. That way you end up spending a little bit less. You get a little bit less protection, of course, but again, if I go back to thinking about what life insurance is, you're hedging against the risk that you're not able to earn all the money you're supposed to earn over the course of your life. And so by layering it like that, I think that makes a lot of sense to have more coverage early and less coverage late. And so that's something that was fascinating. It actually changed the way that I was shopping for life insurance about a year or so ago when I set this up after talking to you and you made that point.
yeah. And the idea that over time you're going to be saving. And so you might not have the assets at 30 that you will at 60 or even
Right.
50. So your need for life insurance theoretically goes down as you get older. And so that's normally, in most cases, the best way to approach it. Term insurance, stagger out some policies across different terms, keep the cost low, and you can cancel those at any time. No harm, no foul. The other form of insurance is more of a hot button topic. It's permanent life insurance. That's where you see the TikTok videos talking about, be your own bank, and that permanent insurance is like this great investment vehicle that's all this is going to help fund your retirement. And I think that the social media phenomenon around and before social media, the blog world phenomenon around permanent insurance gave it a bad rap. I'm not in the either or camp like that. I don't think that permanent insurance is the devil. And I don't think term insurance is the only thing you ever need to consider. I just think the pool for who should consider permanent insurance is probably a little more limited. These policies are generally more expensive, but they are permanent, meaning your premiums accrue and a cash value accrues inside the policy, essentially for as long as it's in force. So there's an investment component to this potentially. You could borrow against them, you can draw against them. So it's almost like it's meant to be this hybrid insurance savings vehicle. I think the use case for them is more limited than term insurance because of how expensive they are. I think the investment outlook for them are, in many cases, less optimal than investing in liquid investment vehicles outside of an insurance policy because you have fewer costs that are dragging against an investment account than you do a life insurance policy. So the expenses are higher, which means the returns need to be higher to get the same result. But for certain things like special needs planning or needing to plan for significant potentially future estate taxes, estate tax liabilities, it's in some cases can work. Again, it's not black or white, but I would say in the pool of potential options, it comes up less often than term insurance does. So the
Yeah.
expenses usually turn people off, but I do think, especially in the social media world, they just get so much attention, and I think they get a lot of attention because they pay really the policies themselves and the insurance companies pay really nice commission to those that sell them.
Well, that part definitely is true, right? Definitely creates a conflict of interest. So, can you help me like back up for a second and understand the distinction a little bit better? Because to me, like term life insurance is very simple, right? Get a 10-year policy, you pay it, each month, annually, whatever it is that you set up, and you're covered for those 10 years. 10 years ends, your life insurance is over, right? You don't need it anymore. But with this like permanent life insurance, how exactly does that differ, right? Obviously, it's in the name permanent. But like how should you think about this in comparison to that term policy?
Yeah, the premium, well, I think it all, you can, start with the premiums. The premiums on term policies tend to be substantially lower than on permanent life insurance policies. And the reason is that because on a permanent life insurance policy, you're paying for several things. You're paying for the actual insurance coverage itself, but you're also making some contribution to the investment component of the account. So you're simultaneously paying for the insurance expense and also uh, towards the future growth of the policy inside the cash value.
So it's like a
So,
hybrid type situation, right? Some of it's going to the insurance premium, some of it's going to this investment vehicle within
right,
the policy.
exactly. And I think at the end of the day, with term, you're purely paying for the cost of the death benefit. Whereas with a permanent policy, permanent life insurance comes in many different shapes and sizes. It's almost like when we talk about annuities, it's so hard to paint a broad brush and talk about them in general terms because they are unique. Different carriers have different policy features. There's things you can add and subtract. For example, there's permanent policies that have long-term care components to them. There's, many different things you can layer on top of them that make them more expensive and more complicated. But in general, with the permanent term insurance, you're paying to cover the cost of the death benefit, but you're also paying towards this future pool that's going to grow and that you could ultimately either borrow against or draw against or pay out at your death. So there is flexibility in terms of the money that goes into it and what you might be able to use it for in the future. There are some attractive tax benefits to how you can draw on those policies. So it's not to say that they don't have good features. It's just because of the cost of them, and specifically the opportunity cost of how that policy might grow versus, say, just a direct investment outside of it in an diversified investment portfolio. It gets a little bit muddier, and that's why people ultimately, unless they fall under a specific set of circumstances, end up electing to purchase pure term insurance and then invest the difference out of
Yeah.
their, whatever
Kind of
extra.
create your own little your own policy there, no strings attached.
Right. So, for example, if you get a permanent life insurance policy and it's got $3,000 in premiums a month, and you found a term policy with $50 in premiums a month, right? You can take the delta between the 3,000 and the $50, right? Which might represent the investment portion, and you can invest that on your own, with much fewer expenses attached to them and restrictions. And over time, the argument is that that pool of money will grow to be something more significant. Um, Now, life insurance payouts are tax free. That is super attractive, as long as they meet certain requirements. But arguably with the flexibility of like a brokerage account and the step up in basis at death, it's included in your state, in a state, there's other things that you can do to look at and kind of plan around that. But it's a balance of flexibility and bells and whistles. And I think
Yeah.
ultimately, people just need to be educated on the difference and the contrast. But I'd say for us, in 9 out of 10 cases, term insurance makes the most sense.
Well, we can leave that there. I think that's a good rundown because, I mean, to me, the world of life insurance gets so complicated and opaque that it can be, difficult to understand. But so 9 out of 10 times, term life insurance makes sense, but it's not 10 out of 10 times. There can be times where permanent life insurance is the right fit depending on your situation. Probably one of those things that you should talk to your advisor about.
Yes, yeah. Also, you should also talk to your advisor and ask him, are we in a bubble? Which I'm going to do right now, Andy.
Are we in a bubble?
We talked about
This is a
this on
question we're
our,
getting a lot. Yeah.
a lot, every call. I keep saying we'll punt this, but it's popping up on like all of our episodes now because it's literally a recurring question. We talked about it in our client
It's
webinar
like
last
the
week.
most common question I'm getting right now.
Yeah, well, school me through it. What do I need to know about the bubble that's
All right,
happening?
here we go. So there's a lot of people right now that I'm sensing are nervous about where the market is. Because on one hand, you look at the S&P 500 and you look at the U.S. stock market, it's making all-time highs. There have been down days, believe it or not, but it just feels like every day the market keeps climbing higher. Every day we get another headline about being at all-time highs. At the same time, I think people are looking around and they see that we're in a government shutdown. Uh, On again, off again tariffs are constant. There's geopolitical strife happening still. And there's just a lot of unease, just this general sense of unease about the direction that things are going in the world, right? And so that's creating this cognitive dissonance where people are saying, on one hand, I'm kind of nervous about what I see. On the other hand, my money has never been worth more, right, than it is right now. And so I think what a lot of people are doing is they're saying, okay, well, there's all these bubbles everywhere. There's this AI bubble. There's this crypto bubble. There's this energy bubble. There's all these bubbles popping up, and it really makes people nervous. And I get it, right? Like we're all everything kind of goes back to those behavioral biases for me, and we're all primed to feel losses more deeply than we enjoy gains. So when we're in this state where everything's kind of going well from a capital market standpoint, it's completely normal just to wonder like about when's the shoe going to drop. So what I'm going to do, and what I'll say is, Alex Shen is our director of research here at Bernie. She does a great job of distilling the economic data that's out there and kind of painting the picture of how things are today. And so what I hope to do is take some of the charts that she shared and paint a picture of optimism and paint a picture of why the stock market, being where it is right now in terms of prices and valuations, actually makes sense and is rational and is not the sign of a bubble. Okay, so we've never done this before, but I'm see if I can share my screen here real quick. Can you see that okay, Adam?
I can see it. And for those that are listening and can't see it, it looks like a lot of colors.
There are a lot of colors. So I'll describe what we're looking at here for those of you listening along and not following on YouTube. By the way, if you are listening but you want to see our faces or our charts here, you can find us at the Bernie Wealth Management YouTube channel. We post all the episodes there. But real quick, the chart I'm showing here is the this recovery coming, April, we had the big down market. So it shows the downturn plus the recovery compared to some other recent 15% or more drops. And what we can see here on this chart is that the S&P 500 did fall pretty quickly. That's pretty normal, but it also recovered pretty quickly and got back to break even. So, I think that's part of the thing that's causing people worry. But then there's a second chart here that we're looking at too on the same image that shows where we are post getting back to break even, right? So the stock market actually, continues to get back to break even and then continues to go higher, continues to set more all-time highs. And so you can see here we're only about 60 or so days, 80 or so days into that post recovery, if that makes any sense at all. So the point I'm making here is this stock market recovery is actually fairly young. And there's plenty of reason to think that it can last longer, both in terms of duration, but also in terms of magnitude. Okay, so that's kind of what we're looking at here, and that's great. You can tell me, okay, great. So the stock market's kind of doing what the stock market does when it recovers from bear markets or almost bear markets. But that's fine. One of those recoveries, one of those good markets looked like 1999, right? And we were all partying like it's 1999. And so we can still be in a bubble here. So what I wanted to show here was another chart that Alex put together that shows what the companies looked like back in the early 2000s, right before the dot-com bubble burst, versus, what the top companies look like today, right? And so, on the first chart here, I have Cisco as kind of like the darling stock. Cisco was going crazy, during the late 90s into the early 2000s. The stock price was far outstripping the expectations based on 12-month forward earnings. So analysts are a big part of what they do is they attempt to project what a company is going to do in terms of earnings per share on a forward-looking basis. That's the whole point of being an analyst, try to predict the future. And what we saw back in 2000 was a huge dislocation between the stock price of the stock, Cisco, one of the top stocks at the time, and what expectations were for analysts. And so a lot of people today are like, well, let's take a look at a modern day stock that's booming, Nvidia, right? It just passed $5 trillion in market cap, first $5 trillion company ever. And people are saying, well, okay, how is it any different from, say, a Cisco, right? In terms of it's going up at an incredible rate. It's gotten to the point where it's incredibly valuable, almost hard to fathom how valuable it is. But I think the interesting thing is with Nvidia, you actually see the share price move in line with analyst expectations for forward earnings expectations, right? So analysts have moved up. They keep moving the bar higher on Nvidia because Nvidia keeps hitting their expectations and actually exceeding their expectations when it comes to earnings per share. So it looks to me like it's pretty rational that we see Nvidia going up because the big difference between now and then is back in the dot-com era, companies weren't making money, and that was kind of like the point, right? It was all promise, it was all hype. Today with the AI boom, yes, there's hype, but also there's money that's being made, right? What do you think about that so far here, Adam?
Yeah, I mean, we talked about this in our client webinar, not specifically about NVIDIA as a company, but the market as a whole, where behind a lot of the noise about the AI boom and bubble and past bubbles, if you look really across most all sectors in the S&P 500, you've got trailing earnings growth that's well above trend, and you've got forward earnings growth expectations that are rising. So, yes, there's a lot of excitement, but also companies are delivering across sectors. So, we're above trend on, look at this.
And
Oh,
this
you've
this
got
is
it.
the this is
Yeah.
the Magnificent Seven right now, right? Like everyone's kind of making money, when we take earnings and we look at the S&P 500, like everything's been positive. But the Magnificent Seven have just been especially good, right? So the chart I'm showing here is just calendar year 2025 so far, normalized earnings revisions for the S&P 500. And it kind of breaks out the Magnificent Seven from the rest. And what we've seen is analysts really did take a meaningful hit to expectations during the whole tariff tantrum era of,
Hmm.
February to April, but then have really revised even higher. So, a lot of people are pointing at the Magnificent Seven stocks saying, well, they're just so overvalued, they can't continue this run. But it's actually the case that they're living up to expectations and they're delivering smashing earnings. And those earnings, by the way, aren't at the expense of profitability. So here's another chart I have for you, which is the profitability of the Magnificent Seven stocks in the top line here against everything else in the market. And we can see that the profitability of the Magnificent Seven is just taken off. And I'd say profitability across the board is pretty good. But in the Magnificent Seven's case, they are outstanding. I mean, these are just simply unicorn companies, the whole group of them. And to me, when I look at earnings increasing and I look at profitability increasing, and then I look at their valuations, it's screams to me like we've got fair value here, right? I'm not really concerned about a bubble because I'm not seeing PE ratios in the hundreds. They're pretty reasonable PE ratios, like in the 30s, and things like that. So, to me, it strikes a pretty optimistic picture about the health of these companies.
Yeah, and I think also one thing we highlight is if all of our clients are asking about a bubble, is it a bubble? Think
Yeah,
about sentiment in the market. You go back to other periods. I know everyone wants to talk about the late 90s where it was everyone at every cocktail party across the country was the FOMO was at extreme levels where everyone was talking about what dot coms they were in. It was the
yeah.
only place to put your money.
Hey,
People were calling their
pets.com,
advisor.
pets.com was just early, okay? They were just
Yeah.
early.
Well, people were
They
calling their
weren't wrong.
advisor, probably saying, "What are you doing? You're buying me these stupid dividend stocks. Get me in where all the growth is and all the excitement. The internet's changing the world." It was euphoric. It wasn't anything like what we're seeing. I mean, we're talking about our client base. We work with a large number of families across the country, but I'm having way more conversations that are, "Hey, should I be concerned?" than, "Hey, Adam, load me up on some more Mag 7." It's not,
Yeah.
we're not hearing that.
Yeah, it's that frothiness you kind of need to be in a bubble where it's like we're throwing caution to the wind. We don't care what price we want to get in. That's a good point. The fact that people are nervous about it is 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 evidence that we might not be in a bubble. It kind of reminds me. I think I shared this with you a little while ago, Adam. But like my sister and I used to joke around. We're like, you know, if I was crazy, you would tell me, right? Like,
Yeah,
because I think part of the point of being crazy is that you don't know you're crazy,
right.
right? So the fact that so
Sure.
many people are worried about this possibly being a bubble is kind of evidence that it's not a bubble. Because the point of being in a bubble is you don't really know you're in a bubble. Everyone's just kind of playing the game.
Right. Well, and I think it could turn into one. I mean, I think it's
Sure.
we've got a new technology that a lot of people are excited about. Expectations are high. It's not to say that this can morph into something that is exactly what we're describing. But that's a great point for your advisory relationship and for an advisor to coach a client through what's the right level of risk. Have your circumstances changed? Are we rebalancing the portfolio? um, I think the people with a close relationship with an advisor and you're having those conversations and you're ahead of it, now's the time to operate from a position of strength and
Yeah, that's
really
a great
make the
point.
right decisions based off your circumstances and not emotions. So I see
Yeah.
more of like your typical retail trainer who's self-directing as being more at risk of like a way over allocating and getting themselves in trouble. Um, where like advisors with the right mindset and really a fiduciary approach to working with their clients are going to factor in a lot more than just, "Hey, which AI stock do we need to be in?"
Yeah. And for the people, I'll call them like the degenerates, right? Who want to gamble with their money. There's plenty of options for them that are outside of just like the typical stock market names, right? There's zero dated options. There's cryptocurrency and ETFs and cryptocurrency world. There's leveraged, multi-levered, single stock ETFs. There's all these little like tools, these little things of hot sauce that people can do and they can play with it. So there's for the people who are kind of speculatively minded, right? There's plenty of tools available for them to scratch that itch. It doesn't necessarily have to be the, US stocks that maybe it was back in the day.
Yeah. Yeah, I totally agree. So if the bubble story isn't what's currently going to kill the market, is it seasonality?
Possibly. So I love seasonality as a topic because everyone's like, oh well, it's the negative ones, right? It's sell in May and go away because the stock market underperforms in the summer. It's September is coming up. It's September is the worst month in the stock market historically, right? So maybe we should get out. But seasonality here at the end of the year, right? We actually talk about the Santa rally a lot around here. There's there's this tendency for the stock market. There's like this trading strategy where the last 5 days of the current year and the first 2 days of the new year see an excess amount of return. So a lot of people kind of load up at the end of the year on stocks, so they want to take advantage of this. But we were looking at this chart here, Adam. That's average return by month in the S&P 500 historically, going back to what 1950,
Yeah.
and it seems like the Santa rally comes early, right? October, November, December, all really strong months.
Yeah, and I think I'm surprised the turkey rally doesn't get more more attention with
Stuff your
November
portfolio. Yeah,
being
that's right.
historically speaking, with November being the strongest month of the year. Um, Santa rally, I think sounds more fun. Everyone's in the holiday spirit, but um, overall a mixed bag. But in general, the September thing always catches my attention. This year, a lot of people were talking about September. Okay, we're coming off a hot start to the year. September's normally down about a half-ish% on average. We had what, a 3% gain in the S&P in
Yeah,
September. Um,
really strong month.
so that's not to say that every year this is how each of these months play out. These are trends and averages over a pretty lengthy period of time. But um, Q4 historically is really strong. Uh, but we saw in 2018, you remember how bad December was with all the tariff tiff, happening at the end of the year. I just remember
Yeah,
Christmas Eve, we had a really, really brutal sell-off. And so
yeah.
things come out
My
of
kids
left
didn't get
field and
presents.
change.
Yeah,
Things come out of left field and throw wrenches into this. Obviously, that's why diversification matters. But um, in general, year end, and this isn't reflected here on this chart, but historically, coming off of a really strong year like this, stocks rarely ever peak in October or September. In really strong years with meaningfully strong gains, they almost always peak in December. So that's just there's probably a number of reasons for that. The FOMO, people feel like they've been watching the markets go up all year and they throw in the towel at the last month of the year and they get excited and they want to ride the year-end wave. It's investment portfolio managers wanting to juice out whatever final bit of return they can for their clients, rebalancing into a more aggressive posture for 2026. In this case, it could be a number of things, but normally it's just we talk so much about momentum and the force of momentum. It's like, gains on gains on gains, right? Like things kind of build on themselves
yeah. It
until they
becomes a
don't.
self-fulfilling prophecy. And another thing is like if it's been a really strong stock market year, people are maybe a little hesitant to sell right at the end of the year when they can just push those gains forward to January and take advantage of the turning of the tax year, right? So,
Hmm.
I'm not sure how much I buy that argument at the aggregate level, but certainly there's like a behavioral element to it. Like I know it's something that we do with client portfolios is if we want to take a big gain, if we can, we'll try to push that to the new year, right? Because you want to defer capital gains taxes as long as possible. So that could be some part of the story as well.
Yeah, no, great point. And we're talking a lot about the U.S. I just before we wrap up, I got to give a shout out to my international equities. Getting just beaten down for the last 10, 12 years as the U.S. has outperformed. We're in a year where if you look at the top countries by return, we looked at this a few episodes ago, but there are some other regions of the world that are really doing incredibly well. Diversification is working, and balanced portfolios are being rewarded for their patience. So
Yeah.
it'll be interesting to see how the last couple of months go. But I think in general, fair to say the general stance right now is earnings are strong, economy's holding up, inflation coming down, rates are coming down slowly but surely. Um, so with the caveat that
There's a
there's
lot of
surprises
positive
that
things
happen.
there. Yeah, well, and that's a great point. There's surprises that happen. So the thing that's gonna, I mean, because we know the stock market will fall again in the future, right? We've talked about how corrections happen about once every year on average, and the big bear market happens about once every 5 years. So like we know there's gonna be another market correction at some point in time, but what we don't know is what's gonna be the trigger of that, right? And so when things are good, it's my preference to keep betting on the stock market when it's going up. Quite frankly, if I look at the U.S. economy, I look at the U.S. stock market. There's been a lot of headwinds over the last 15 years, a lot of things that could have knocked it off its game. But the U.S. engine has just kept marching forward. So, I'm going to keep betting on the U.S. economy and the U.S. stock market really until proven otherwise. You're right about international diversification finally stepping up and working, and that's great. It doesn't have to be either or. It can be U.S. and international, right? And so, to me, I'm just going to keep betting on the U.S. stock market and the international stock market as places that are, probably a pretty strong place to be moving forward.
Yeah. All good stuff. Great questions, everyone. It's not too long from now. We'll be diving into our holiday themed episodes. Get your thinking
Are you
cap
going to
on,
dress up for
Andy.
that one?
We're going to have to. One of us is going to be an elf and one will be Santa, but we'll figure out what that's going to look like. We've got about
As long as
a
neither one
couple.
of us is the Grinch.
Yes. Yeah,
Maybe
exactly.
maybe we can get your wife to be the Grinch since she was Ursula.
Yeah. I'll tell her you said that, and then we'll we'll
Please
we'll,
don't.
we'll go from there. But yeah, email question. Bring in great questions. Long story short at BurnyBurney.com. Thanks, and we'll see you next week.
This podcast featured Adam Newman and Amy Pratt of Burney Wealth Management, which is a division of the Burney Company, an investment advisory firm. Adam is managing partner and is chartered financial analyst, certified financial planner, master of taxation, and retirement income certified professional. And Andy is senior partner and director of investment strategy and is a chartered financial analyst and chartered alternative investment analyst. Long Story Short involves general discussions of a broad range of current financial topics related to financial planning, taxes, investment, and retirement. This content is for informational educational purposes only and is not intended as personalized investment advice or recommendation. It does not take into account your financial situation. You'll need to consult with a qualified financial advisor or professional who's familiar with your specific circumstances. Investing involves risks, and past performance is not indicative of future results. The Burney Company is an SEC registered investment advisor. Registration with the SEC or any state securities authority does not apply to the Burney Company or any of its principals or employees, possesses a particular level of skill or training in the investment advisory business or any other business. Burney Company does not provide legal, tax, or accounting advice, but offers it through third parties. Before making any financial decisions, clients should consult their legal and/or tax advisors.